Hey Gemini, what is a public company stock? If I were to buy a stock, what does it mean?
The basics of public stocks. At its core, a public company stock, also known as shares or equity, represents a piece of ownership in a corporation. When a company goes public, it sells portions of itself to the general public to raise money for things like expansion, research, or paying off debt. What does ownership mean? If you buy a stock, you become a shareholder. While owning one share of a massive company won't give you an office in their headquarters, it does grant you a few specific rights. Claim on earnings. If the company makes a profit, you may be entitled to a portion of it. This is often paid out as dividends. Voting rights. Shareholders usually get to vote on major corporate decisions, such as electing the board of directors. Asset distribution. In the event the company is liquidated, you have a claim on the remaining assets, though shareholders are usually last in line behind lenders and bondholders. How buying a stock works. When you buy a stock, you are essentially betting on the company's future. There are two primary ways to make money from this investment. 1. Capital appreciation. You buy the stock at a certain price and sell it later at a higher price. This is the classic buy low, sell high strategy. 2. Dividends. Some established companies share their profits with investors regularly.
I wanted to make a video about the mindset which is necessary in order to buy a stock. And that's why I asked Gemini that very question. You need to know what it means to be a shareholder of a company. Now, usually when we buy stocks through Fidelity or E-Trade, we are buying a common stock. There are also preferred stocks. You'll have to know the difference between the two. And when we buy a common stock, that is an asset class. You'll have to understand that, like all other asset classes, it goes through cycles. Whether you buy real estate, or you buy precious metals, or you buy crypto, those are all asset classes. And history teaches us that each one of them, it will crash and it will drop 50, 60, 70% once or more times in our lifetime. So it is important that you are aware of that. And usually when we say stocks, we refer to the S&P 500. Anything can happen to individual stocks, okay? It is important in this perspective to be diversified. Like I was watching an interview with Ray Dalio, and he's really big into diversification. And he said, if you want to be successful, you'll have to find at least 6 or 8 uncorrelated assets. One can be common stocks, the other one can be real estate, the other one can be gold, the other one can be cash, the other one can be investing in a sport team, etc. If you can find uncorrelated assets, that is true diversification. The other thing too, you might want to find assets that they are not US dollar denominated, because if something happens to the US dollar, you are going to have a safety net. Now let's focus about stocks. Now that we know what is a stock, why do stock exist? Or in other words, why would a private company decide to go public? Let's ask that to Gemini. Hey Gemini, why would a private company decide to go public? And before the IPO, what are the steps that a company takes to raise money, like Series A, B, etc.? Can you explain that?
Moving from a private company to a public one is essentially moving from a small circle of trust to a world of open doors. Here is the breakdown of why companies make this leap and the ladder they climb to get there. Why go public? The why. A private company, owned by founders, employees, and a few investors, often reaches a point where it needs more fuel than a few individuals can provide. Massive capital injection. The primary reason is to raise a huge amount of money at once to fund massive expansion, build factories, or acquire other companies. Liquidity for early believers. Going public allows early employees and founders to finally sell their shares and turn their paper wealth into real cash. Brand prestige and trust. Being listed on a major exchange, like the NYSE or NASDAQ, provides a stamp of approval. It makes it easier to hire top talent and win over large corporate customers. Currency for acquisitions. Public companies can use their own stock as currency to buy other companies instead of using cash. The pre-IPO ladder, funding rounds. Before a company is ready for an IPO, initial public offering, it usually goes through several rounds of private funding. Each letter, A, B, C, usually signifies a higher level of business maturity. 1. Seed round. This is the planting the garden phase. The company is often just an idea or a prototype. Source: friends, family, or angel investors. Goal: to prove the idea works and find a product market fit. 2. Series A. The proof of concept. The company has a product and some customers, but it needs to refine its recipe for success. Goal: scaling the product and optimizing the business model. Investors: venture capital, VC firms. 3. Series B. Scaling the machine. The business is working well, and it's time to grow fast. Goal: expanding the team, entering new markets, and beating competitors. Investors: larger VC firms that specialize in later stage growth. 4. Series C and beyond. The home stretch. At this stage, the company is usually quite successful. It might be profitable or very close to it. Goal: preparing for a big move, either an acquisition or an IPO. Investors: large institutional investors, hedge funds, or private equity firms. The final step, the IPO process. Once a company decides to go public, it doesn't just happen overnight. It is a rigorous legal and financial marathon that usually takes 6 to 12 months. 1. Hiring underwriters. The company hires investment banks, like Goldman Sachs or Morgan Stanley, to manage the process, price the shares, and find buyers. 2. The S-1 filing. They must file a massive document with the SEC that discloses everything: their risks, their debts, their executive pay, and their financial history. 3. The roadshow. Executives travel around to meet big institutions.
And now you know why a private company would decide to go public. But the thing is that once it comes the day of the IPO, that one company has already done several funding rounds, and it could already be way overvalued. You'll have to understand that. A lot of people don't know too that a company, when it goes public, it only makes money once, in theory, that one day. And unless they dilute the shareholders and they issue more shares out of the thin air, they are only gonna make money once. So my point is that every time you buy a stock, you need to understand that why even that stock exists, okay? And what price you are paying, at what valuation you are buying that stock. What is the market cap, okay? What is the revenue of that company? What is the profit, etc. It is important that before you even get into the stock market, you understand that why do we even have a stock market. A lot of times what happens too is that the IPO, the insiders are going to immediately sell. That's not a good sign, because usually what happens the day of the IPO, share price skyrockets. And at that point, while let's say that a company is doing an IPO for $1 billion and the stock price it goes up that very day, it might very well be that they are going to halt the trading on that stock because people are out of control. And that happens quite a bit. I remember when Figma recently went public, and it was already at a very stiff evaluation. Also, all of the EVs, when they went public, I believe Uber, a lot of those companies, they were already way overvalued. And the same thing happened to Robinhood. When they went public, I remember that the insiders were immediately selling. And that is really not a good sign, because what happens then is that the stock price might plummet, and you, the shareholders, are going to be left holding the bag. Okay, so it is very important. Let me also ask you one more question. Hey, Jomana, what are the minimum requirements for a private company to go public? Like, is there a minimum revenue or profit or number of employees or number of years they have been in business, etc.? What are the requirements to go public?
Going public isn't just about being big enough. It's about meeting a specific set of mathematical hurdles set by the stock exchanges, like the NYSE or NASDAQ, and the SEC. As of early 2026, these standards have tightened significantly. There isn't one single minimum, but rather a choice of different tracks a company can take. 1. The financial hurdles. A company usually has to prove its worth through one of several financial standards. You don't necessarily need profit if you have massive revenue, but you must have at least one of the following. Common tracks for listing, e.g., NASDAQ Global Market. The earnings track. You need a combined pre-tax income of at least $11 million over the last 3 years. The revenue track. If you aren't profitable yet, you generally need at least $110 million in revenue over the last year, plus a massive market value. The assets track. A company with at least 80 million IN total assets and 55 million in equity can sometimes list even with lower revenue. 2. Liquidity and ownership requirements. The exchange wants to make sure that once the stock starts trading, there are enough shares moving around so the price doesn't jump wildly. Public float. As of 2026, the NASDAQ has increased the minimum value of unrestricted shares held by the public, not insiders, to at least $15 million. Shareholders. You typically need at least 400 to 2,200 round lot holders, investors who own at least 100 shares each. Stock price. Most major exchanges require a minimum initial share price of $4. 3. Operations and governance. Operating history. While there is no age requirement, a 1-year-old company could technically go public, most exchanges prefer at least 2 years of operating history. In reality, The average company is about 10 to 15 years old by the time it reaches an IPO. Audited financials. You must provide 2 to 3 years of financial statements that have been strictly audited by an SEC-approved firm. Board of Directors. You must have a board where the majority of members are independent, meaning they don't work for the company. 4. The SEC 2,000-person rule. There is a specific legal trigger that often forces private companies to go public even if they don't want to, under Section 12G of the Exchange Act. If a private company has more than $10 million in assets and its stock is held by more than 2,000 people, or 500 people who aren't accredited investors, it is legally required to register with the SEC and report its financials publicly. Summary table. Requirement. Typical minimum price, $4 per share. Public shareholders, 400 plus. Market value of public shares, $15 million, $25 million plus. Audited history, 2 to 3 years. Board structure, majority independent. Because these requirements are so expensive to maintain, legal and accounting fees alone can cost millions annually. Most companies wait until they have at least $100 million in annual revenue before seriously considering an IPO. Are you looking into how smaller companies trade, such as those on the over-the-counter OTC markets?
Okay, those are the requirements for a company to go public. A lot of times insiders sell a whole bunch of their own shares on the day of the IPO if the price was to go up a lot. What does it mean?
It's a common misconception that insiders, like the CEO or early employees, can just dump their shares the second the stock price jumps on IPO day. In reality, the system is designed to prevent exactly that. Here is the breakdown of why insiders usually can't sell immediately, and what it means when they finally do. 1. The lockup period, the 180-day rule. When a company goes public, the investment banks, underwriters, almost always force insiders to sign a lockup agreement. The rule. Insiders are typically forbidden from selling a single share for 90 to 180 days after the IPO. The reason, if the CEO and founders sold everything on day one, it would flood the market with supply, crashing the price. It would also look like the captains are abandoning the ship, which scares away new investors. 2. Why do they sell eventually? When that lockup period expires, usually 6 months later, you will often see a wave of insider selling. While it can look bad, it isn't always a red flag. The payday factor. Many employees have been paid in stock for 10 years and have a low salary. For them, this is finally the moment they can buy a house or pay off debt. Diversification. If 99% of your net worth is in one company, it's a huge financial risk. Selling some shares to buy other investments is just smart personal finance. Tax bills. In many cases, insiders must sell some shares just to pay the massive tax bill that is triggered when their stock options finally become liquid. 3. What if they do sell on the first day? Technically, there is one way insiders sell during the IPO, a secondary offering. Sometimes, the IPO includes 2 types of shares. New shares, the company gets the money, and existing shares, the founder gets the money. If a founder sells a huge chunk of their personal shares during the IPO itself, investors often see this as a warning sign. It suggests the founder thinks the IPO price is the highest the stock will ever be. How to track this? Form 4. As a public company investor, you don't have to guess. The SEC requires all insiders, officers, directors, and 10% owners to file a Form 4 within 2 business days of buying or selling. Reading the signals. If an insider, it usually means sells a small percent regularly, standard financial planning / automated selling, sells a massive chunk suddenly. Could indicate they expect bad news or a price drop. Buys with their own cash. The strongest green flag. Insiders sell for many reasons, but they usually only buy for one. They think the price is going up. Since you've been tracking market sentiment, have you noticed any specific tech or AI companies where the insiders have been?
So, okay, it is important to be aware, you as a stock buyer, of all that. Okay, what management does, what ownership does, what the insider trading is, etc. Now, all of those information, all of the information is available online. You can use, of course, Seeking Alpha tells you, or MarketBeat.com. It tells you all the insider trading activity. And I always look into that before I buy a stock. It doesn't matter what the price is, it doesn't matter what the company is, whether or not I like the company, etc. So now that you have a general understanding of what buying a stock in a public company is, I'm gonna tell you now what stocks to buy, okay, and when to buy them. It is important that you are aware of your financial goals, okay? That also depends on your age. If you are in your 20s, 40s, 60s, etc. And of course, it depends on your time horizon. Of course, if you are 20, you can take more risk. If you are 70, less. Actually, it's been said that your age, it is the percentage of your portfolio that you should have in bonds. So if you are 60, you should have 60% of your portfolio in bonds, because they're less risky. And I can imagine that you're 60, you are retired, or you're close to retirement, and you value more stable income, or rather steady money, that gamble your money on a possible appreciation. The other thing is that I would rather buying a stock in a very established company at a discount than buying a stock today because I hope the stock is gonna go up. Let me give you an example. I would rather buy the stock of MasterCard during a stock market crash, because I know that it's a very stable company. I do know that it's a duopoly with Visa primarily, and it's a great company. They profit, they have a net income which is a high percentage of the revenue, and they have a moat around it. And I think MasterCard is going to be able to adapt whatever the world of finances is going to be in the next 5, 10, 15 years. Rather than buying SanDisk, which is a hot stock right now, that company makes memory chips for AI. So the mere fact that you can invest, you have money to invest, it doesn't mean that you have to invest. I see a lot of people nowadays that chase the flavor of the day, whether it's Micron or Lumentum or whatever the newest chip company is, or the latest technology is, and I will stay away from those. I remember watching an interview with Peter Lynch, and he said that you want to stay away from the hottest stocks in the hottest sector. And right now we got AI. Everyone is rushing about AI, and eventually they're gonna be left holding the bag. Now, will AI change the world? Possibly. It already has. But see, history repeats itself. And what history teaches us is that a lot of investors in new technologies are going to lose 70, 80, 90% of their money. Like when they invented electricity, or they invented cars, or when they invented radio and television, invented airplanes, or invented the internet. Well, if you were to buy car companies after they invented the car, or you were to buy airlines stocks when they invented the airplane, you'd be left with 10% of your principal. And did cars change the world? Yes. Did airplanes change the world? Yes. But yeah, you know, when they invented the car, there were like 2,000 car brands in the United States. Today, 3. If you were to invest in a whole bunch of internet stocks during the 2000 dot-com bubble, you were left with nothing. And if the internet changed the world. So, you know, you investing in a technology that is innovative and it's the flavor of the day, it doesn't mean that it's going to be profitable for investors. So once again, I would suggest you guys to buy a stable company, a well-capitalized company that has been around for a while, than buying a company which stock has been trading only for a couple of years. It's not enough. It's not enough a trading history to justify you guys buying a company. And I'm seeing all kinds of things on the internet now, YouTubers promoting companies at the IPO, or SpaceX with XAI, or you know, whatever company is gonna go public in 2026, or the company that just went public in 2025. I would definitely stay away from those companies. So this was gonna be a video about what stocks to buy. I would say what stocks not to buy, and stay away from the flavor of the day. Okay. Also, stay away from a company stock that has been trending up a lot over the past 6 months to a year, that is trading at an absurd multiple ratios. I would completely stay away from those. Also, stay away from a company that has been trending down a lot the next, or rather the past year, 2-3 years. Like, I'm thinking about PayPal, or I'm thinking about Nike, thinking about Adobe. I would completely stay away from those. They are value traps, and possibly it might take a very long time for a turnaround, if there is a turnaround. Once again, I would buy a stable company like Google, JP Morgan, MasterCard. You only really need to buy great companies. 2, 3, 4 great companies is already gonna be enough to profit. and let time do all the work. What a lot of people don't understand, they think that they're gonna come up with the next Nvidia or the next Tesla to profit from the stock market. I say you have to buy the right companies. Like one of them, it can be JP Morgan. But you have to buy it at the right time, during a stock market correction or during a stock market crash. You have to be able to take the temperature of the stock market. Right now, stock market is hot. And even during the Iran war, the stock market hasn't really softened up a lot yet. Now, who knows what's going to happen? I know there is peace talks going on, but you never know. I think the stock market is being over optimistic about this war. But regardless, I would stick with good, profitable, well-established company that have been around for a long time. Like again, one of them could be MasterCard or Visa or companies that have a moat around it. And then I would buy a bit of the dividend stocks, just in case that your primary stocks are going to go through a tough time. You are going to stay afloat with some dividend stocks paying you 5, 6, 7, 8%. Like it could be Verizon, could be Pfizer. Those are stocks that their stock price doesn't move a lot, okay? And also you can buy some REITs or utilities companies. I would buy REITs to diversify. Real estate is always gonna be there. I usually buy Realty Income, I buy EPR, I buy AGNC. Those are companies, some of them they pay monthly dividends, which is real good to get income every month. And AGNC too, they have monthly options, which is a good thing because you can make money from the premium and from the dividends. You are possibly gonna make more money from the premium, but that's a whole different conversation for another day. So also you can buy on the side, you can buy a couple of junk bonds. Usually bonds and stocks move in a different way. Now in 2022, we've had a drop in stocks and bonds, but the bond market is much bigger than the stock market, okay? So I would diversify a little bit with that, and I would add a bit of treasury bill in your portfolio. That's gonna be your dry powder for the next stock market correction, the stock market crash. You're not gonna have to sell your stock at a loss. You have cash on the side, or you have treasury bills, ETFs on the side. That is money which is gonna be there for you whenever you need it, regardless of what the market does. Actually, during a stock market correction or a stock market crash, people flock to the US dollar. So treasury bills are going to go up. You can hedge your portfolio by buying tips or buying short-term income, like a JPST, which is the short-term ETF from JP Morgan. There are a whole bunch of those. Every bank, every financial institution has the short-term that pays you about 4%. When the market is hot, it's not easy that it's going to deliver to you 4% yearly. Actually, at these levels of the Buffett indicator and these levels of Cape-Shield ratio, historically, stock market is going to return 0 to 2% over the next 10 years. Imagine that. More than likely, your return is going to be negative. So it is always good to have some bonds, some treasury bills, and some cash. I would stay 5% in cash, not even treasury bills. I would leave it there for emergencies, and whatever happens, you have the chance to weather the storm. You're gonna need money for an emergency or for whatever reason, and you're gonna have cash right there available for you. The other thing that I would recommend is mix it up with a little bit of ETFs. ETFs are, let's say, you are gonna maintain your status with ETF. You know, anything can happen with individual stocks. A stock price can drop a lot. Anything happens to a company, could be a bad news or a downgrade or missing earnings estimates or a lawsuit. And so if you have ETFs, pretty much they're gonna move with the S&P 500. Sector ETF, I would stay away from it. International ETF, I'm not really huge in international. Like Warren Buffett said, don't bet against America. And also American companies do a lot of business internationally, so you already invested internationally just buying American ETFs. And that's it. I was only gonna give you guys the mindset to buying a stock, what to stay away from, and you'll have to understand that individual stocks are risky. You have to know how to screen a company, you'll have to know how to pick a company, and then you're gonna have to wait for the right time to buy its stock, and you are going to be willing to wait years to profit and let the time do all the work. You really shouldn't put money in the stock market if you need money over the next 5 years. Like Warren Buffett again says, don't even think about holding a stock for 10 minutes if you're not willing to hold it for 10 years. Okay, so think long term, and you're gonna be successful. If you pick the right company, the companies they have more around a durable competitive advantage, and let the process work in your favor. Okay, I'm gonna wrap this thing right now, and I appreciate you guys for watching. Let me know if you have any question on this video. I know that this is just the beginning, and there is gonna be a whole lot of nuances linked to this introductory video, but I appreciate you guys for watching. Happy trading, and have a good one, everyone.